very sleek. Charles Pellegrino's with us. You got your eye on several of those, Charles?
I don't even have a driver's license.
Oh, do you have a driver's license? Well, they look very pretty, though, don't they? He's also got his eye on big tech groups. They're sharing their latest results this week. Learn something new every day. One item in particular, the focus of investors, AI spending.
Let's look at Meta Platforms, the owner of Facebook, Instagram, and WhatsApp, and Microsoft as well, both of whom reported their latest results on Wednesday. Mark Zuckerberg's Meta announced that this year they're planning on spending anywhere between $150 and $135 billion on capital expenditure to build out their AI business, notably in the form of massive data centers to achieve what they call super intelligence, a point at which machines will outthink humans. Microsoft, meanwhile, said it increased capital expenditure last quarter by over $37 billion. That's 66% more than a year prior. The software provider working to integrate its AI tools, often powered by OpenAI, into its various products. But the reaction from investors has diverged for both those groups based on their actual ability to generate sales that would prove that spending so much is actually justified. Meta's advertising revenue surged 24% in the last quarter, and its shares were trading significantly higher after hours. As you can see, they're up over 6.64%. Microsoft, meanwhile, posted slightly lower growth in sales in its Azure cloud computing unit, and its shares tumbled.
Well, this pivot towards artificial intelligence also happening at electric vehicle maker Tesla.
The company run by billionaire Elon Musk is shifting its focus towards AI and robotics, especially its robotaxi. That's what I'm betting on to not have my license. Its annual revenue actually fell for the first time last year as this shift is underway. Tesla announced it would stop production of its Model S and X vehicles and use the manufacturing plant in California that made those cars to produce its line of humanoid robots called Optimus. The group also revealed it'll invest $2 billion into xAI, Musk's artificial intelligence venture, that'll ramp up spending by an estimated $20 billion.
For those who are already actually benefiting from the AI spending, the hardware providers, this is like Samsung Electronics?
The saying often goes, don't bet on the gold rush, but bet on the people making the shovels used during the gold rush. In this case, it's the makers of chips, computers, and servers, companies like South Korea's Samsung Electronics, which posted a record quarterly profit this Thursday, triple more than the previous year. Its revenue climbed up to over 93 trillion won, so that's about over $65 billion. Demand for chips is so high right now because of that surge in AI spending that we're actually seeing shortages, especially for basic memory chips, which are just chips that store data. So potentially creating supply problems for makers of smartphones, cars, and electronics. Those are just the figures coming from the companies that reported this week, but more info to come next week with Amazon and Alphabet's results, and more fodder for that question that's on everyone's lips. Are we in the midst of an AI bubble?
I suspect so. Markets, how are they reacting to all of that?
Well, shares mostly higher in East Asia after the U.S. Federal Reserve's decision to keep rates steady in its first meeting of the year. Samsung Electronics started the session higher after those results, but reversing course by the end of the session on the Kospi and Seoul. European stocks pushing higher at the open as well, except for the DAX index in Frankfurt. A lot of earnings reports coming this Thursday to keep an eye on. We'll be doing that later on.
Charles, thanks a lot. We've gone to cars. Now we're going to talk about fashion. Fashion Week underway here in Paris. Luxury brands really showcasing their haute couture collections for the upcoming seasons.
Danish capital Copenhagen also hosting a fashion week ahead of Milan, London, and then New York. But the traditional fashion industry is facing increasing competition from ultra-fast fashion that has transformed consumer behavior and expectation. Yuka Roye has a story.
Summer has arrived on the runway. Dior, Chanel, and Valentino. Iconic luxury fashion houses unveiling their light and colourful new collections with traditional elegance. But they're no longer the only trendsetters in today's fashion world. Ultra-fast fashion giants like Shein are increasingly using AI to track trends on social media, come up with new designs, and have them delivered faster and faster.
This is a business model that differs dramatically from the established fashion industry, where time, effort, and resources are invested in developing creative designs.
The global fast fashion market is projected to reach $178 billion in 2026, according to Fortune Business Insights, chipping away at the luxury apparel sector that has been seeing slower growth in recent years. Fast fashion brands have long been accused of fueling a culture of overconsumption, as well as distorting competition.
The problem with ultra-fast fashion operators is that they've found a loophole in European legislation. They've registered themselves as a social media platform, which means that they cannot be held accountable for the products being sold.
Governments have moved to rein in ultra-fast fashion. Last year, France passed legislation aimed at curbing the sector's carbon footprint by introducing an eco-tax and eco-score on fashion items. The government also recently asked its textile recycling agency, Refashion, to propose a stricter penalty framework for ultra-fast fashion platforms.
Charles, thanks a lot. Charles Pellegrin there with the business of France 24.